Our mission is to empower people to help them make good financial decisions. It's our job, our mission is to go out, educate people so that they can make an informed financial decision and get to where they want to be financially.
MFP specializes in really understanding who you are. What is your mission? What are you trying to accomplish? And we believe that everybody should make informed financial decisions. So our skill set is understanding who you are at your core, walking you through multiple options of the different ways that can get you to where you need to be. And then together, we will build that plan together. It might be a retirement income plan. It might be a legacy plan. It might be sending all your kids to college. It just might be saving money on taxes. But whatever is most important to you, we will build a plan that reflects that.
One of the biggest motivators for us as a firm is we want our clients to get to where they want to be. It's not just from we want to sell you something, right? It's we want to be an important part of the path that got you where you wanted to be.
When we say empower people, I'm really meaning like most people in financial services to get talked at, not talked to. So they talk at them and say, hey, you should do this, you should do that, instead of saying, hey, what's important to you about X, whatever that X is, that X factor that's important to you, and understanding them through their lens, and then saying, okay, here's how we can build something that'll get you to what you said was important, and here are the action steps that you need to take, because sometimes all problems can't be solved with one action.
We are helping people make informed financial decisions because ultimately, everybody has different goals, everybody has different things they're working towards, and there's nothing worse than trying to make a decision and you don't know what to do, right? Like maybe you're reading something, you don't even know what it means, right? And so our job is to help you make those informed decisions so you can confidently get to where you want to be.
The vision for Mission Financial Planners is ultimately to develop a network of like-minded fiduciary professionals, one that we're able to take care of all of our clients' needs. And we start with financial planning, but it's going to grow. And what's really exciting is we don't know exactly how it's going to grow. It might be everything from one day we're bringing in a Mission Financial individual that is helping with your P&C insurance, that's helping you with your real estate, purchasing investment properties or selling and buying your forever home. Whatever it is, if it takes good advice, I would love for one day that we provide that, and it's with somebody within our network. People and businesses should work with Mission Financial Planners ultimately because of the skill sets that each of us bring. Myself through the process, Matt through his ideas, Jason through his deep understanding of advanced plannings and the tax laws. All those together get our clients to a place that sometimes transcends their initial goals and expectations.
MFP is a culture of learners. That's just the culture of our business, is get better so we can make our clients better.
And the reason people should choose Mission Financial Planners is because we're holistic. We look at the whole picture. We're not just a portfolio manager. We do look at the whole picture. And that's why people should choose us.
Hey, good evening, everyone. It's Matt Donahue and Ken Hamilton again. Thank you for coming back for round 3 of our retirement readiness series. The last couple weeks, you've learned a lot about Social Security and Medicare. Today, we're going to scratch the surface on tax planning. And I do mean that when I say scratch the surface. There are so many different potential applications from a tax planning standpoint for everybody that the stuff we're going to talk over today is very high level. But just know that for your situation, whatever that might be, we will dig in as deep as we need to. Right up front, I got to tell you, we are not CPAs. We do not give tax advice. We can help you with tax planning, though. And to make that as effective as possible, in many cases, the best thing you can do is introduce us to your tax preparer or your CPA. The reason I say that is because a lot of times people will take what we talk about in these presentations or one-on-one with our clients, they'll take it to their CPA, and maybe the message gets a little muddled and the CPA is like, that sounds like a horrible idea. If we're there to have the conversation with the CPA to say, hey, we're thinking about next year's tax bill, we're thinking about the tax bill 5 years down the road, 10 years down the road, we want to set up some of these things now to help mitigate that. Suddenly, the tax professional says, yeah, that's a great idea. You guys should absolutely do that. So you're going to get a lot tonight about tax planning. Again, it's meant to be high level. It's meant to be high level. And in fact, we're going to start with a little tax brain teaser here. So we have a guy who's retired. His adjusted gross income, not his total income, right, but his adjusted gross income is about $46,000. He has $38,000 of IRA income. He has about $38,000 of Social Security income, and he decides he's going to pull $1,000 out of one of his IRAs to go on a road trip. Okay. How much should he owe in taxes? Well, if he's in the 22% tax bracket, he should owe $220 on next year's tax bill, right? Wrong. He's going to owe over $400 on that tax bill. And I'll explain why in a few minutes, but this is just a simple example of something, kind of that doesn't seem like a big deal, suddenly can blow up a tax bill in a year or two. And of course, how do you pay the higher tax bill? You pull more money out of accounts. What does that do? That generates more taxes, right? And so it just becomes a spiral at that point. So there are different stages of retirement. We'll talk about the 4 stages of retirement. Again, we're in 28 states, right? And tonight, everybody on the call tonight is from Texas. So we're not going to talk state income tax at all. We're based in San Antonio as well. So, for us, it's what it is. We do have a lot of clients in other states that do have a state income tax, and we can help them as well. So if you are one of those California expats, right, who's moved to Texas and you've got a bunch of friends and family back in California, we do a lot of business there. We can help those people with tax planning as well. Other states that have, state income tax, we can help them, right? So your friends and your family that you're thinking of, make sure you let us know. Now, I said we don't give tax advice. Malloy Management Group over on the right there, they are our partner in terms of tax advice. We also, through Integrated Trust Systems, work with a great tax attorney. So if you do have real detailed questions that maybe go a little bit beyond your basic or your standard tax advice, you might want to talk to Nathaniel Landman over at Integrated Trust Systems. He is a tax attorney. He can work in all 50 states. He's based out of St. Louis, Missouri. But we do have the resources for you if you need them to help address significant tax issues. So I mentioned at the onset tonight that we're in round 3 of our retirement readiness series. Well, next week is round 4. Next week is estate planning. So if you think about this, there's a definite logic to why we present in the order we do. So Social Security affects a lot of people, right? It's income planning. Right? That's what you're thinking about when you start to retire. One of the things you're thinking about when you're starting to consider retirement. Well, then we got to think about, okay, what's my health care plan going to be? And that's why last week we talked about Medicare and long-term care. How do I keep as much as I can so I don't get, this huge tax bill every year or create a tax mess for people after I'm gone? That's why we're going to talk about taxes tonight. And then, of course, that leads right into, well, what does happen when I'm gone? Which is why next week is going to be on estate planning. I mentioned this already, so I'll kind of jump past this. We don't give tax advice. We can certainly help with tax planning, though. And like you saw with that road trip example, but guys, it really is a different tax regime in retirement than it was when you're working. A lot of the things you were used to getting, in terms of tax credits, 401k contributions, those knocking income off, stuff like that, all that goes away when you're retired. Now you're looking at, how's my Social Security get taxed? What are required minimum distributions or RMDs? How am I going to pay for Medicare? How am I going to pay for long-term care? What should I do from an estate planning standpoint to make sure as much as possible of what we as a couple or you as a person have built up over time goes to the family, friends, and causes that you care about, right? those are a lot of questions. So what's the first thing you need to understand? Number one is, what does your after-tax retirement savings picture look like? And you should know that before you retire. So as an example, if you have $500,000 in your 401k at work or in an IRA, it's not 500,000, folks. Every last dollar of that is taxable when it starts coming out of the account. It's taxable at income tax rates. Okay, so you don't have 500,000 in there. You don't. And if you're going to pull the whole thing at once, which I don't know why you would, but if you did, you're going to lose basically a third of it to taxes on the way out the door. If we took a portfolio that had just $400,000 in it and it only got a 6% rate of return, you can see the distributions here. The distributions on a 33% tax rate on 25 years, it would only generate about $600,000 of distributions. If we can get the tax rate down to 12%, it puts it up to about just over 800,000. And if you can actually get all the way down to the 0% tax bracket, which I'll be super candid, if you've got a pension, if you've got a lot of dividend and interest income coming in, it's going to be tough to get down to that 0% tax bracket. Not saying you can't do it, but it's going to be tough. You're getting closer to $1 million in total distributions. Okay, so that's a bit of a warm up. I'm going to turn it over to Ken for our first breakout session. Ken, what are we talking about in the first breakout session tonight?
Like the rest of the conversation, talking about taxes, but more importantly, understanding tax location, but also the trend of where taxes are today and where we're going. So what you're seeing on the screen right now is the top marginal tax rates. Now, if you want to throw it in the chat, sometimes we'll do a poll of, do you feel like we're in a high tax environment or a low tax environment? And most people, and I see one or two of you throwing in the chat saying that it feels like it's a high tax environment. Now, again, it might feel that way, but historically, with a high tax bracket today being 37%, let's take a look back at where we were in the 30s, 40s, and 50s. The high tax bracket was over 80%. So pretty substantially high. It didn't start coming down until the 60s, which again, where that high tax bracket was in the 60s. And it wasn't until the 80s where we've been at for a relatively long time with a high tax bracket below 40%. Now, you also understand where we're at with the country as a whole, where our deficits are at, especially with all the COVID relief packages. Debt's through the roof. And so the the tax rates were really high in the 1940s through the 60s to cover the cost of the Great Depression and World War II. Well, we're coming out of the Great Recession and we're still dealing with the COVID relief. We need to find a way to ultimately pay for that. So one of the things we need to be thinking about is it's going to get paid one way or the other. And of your assets, how taxable are they going to be? Are there things we can do to reduce that tax exposure of your assets? And so this is where the tax location part of the conversation comes in. And it really comes down to three main categories. Are your assets tax deferred? Are they taxable or tax-free? Tax deferred accounts are your IRAs. They're your pensions. If you have any non-qualified annuities, you put money into it, it grows, and as it's growing, you're not being taxed. But when you take $1 out, it'll be fully taxed as income. Now, the real question you have to ask yourself is, what's the tax bracket going to be at that time frame? And back to the brain teaser, is it going to only be taxed on the federal level, or will it be triggering other taxes that maybe we're not aware about? Then there's taxable accounts. This is your brokerage investments, but I would also include your real estate as well as your bank accounts. Your money markets are finally yielding 4% and 5%. Yay. Bad news is we have to pay taxes on that interest. Your real estate, we pay taxes on that on the income that's coming in, and you're being taxed every single year, either at the capital gains rate or at the income rate, depending on exactly where it's coming from. And then the last bucket is tax-free. And for most individuals, this is Roth IRAs. Roth 401ks are now broadly adopted, something that if your employer offers it, or if you're a business owner, maybe installing a Roth 401k into your lineup. But looking at these three buckets, thinking about your last 30, 40 years of accumulating your wealth, how much of your money is tax deferred, taxable, and tax free? If you had a choice, how much would you want of your assets to be tax deferred, taxable, or tax free? And one of the main things that we do with a lot of our households is understanding where you are today in the process, the efficient process of shifting your assets to a more tax-free location. Matt?
All right, Ken. So we're talking different buckets, right? We're talking different tax rates. Well, okay, Social Security will be there. Medicare is going to be there, right? I mean, that stuff doesn't really cost me anything, right? Well, we got to watch out because they have their own tax traps too. So Social Security and taxes. First thing, remember that 40% income tax we talked about? Well, the reason why, and I won't take you through all the numbers tonight, folks, but the reason why is because it changed how his Social Security got taxed. If you recall way back to 2 weeks ago when Ken took us through the tax example with Social Security, there's 3 different tests they send your income through when it comes to determining how they tax your Social Security benefit. And basically that $1,000 was enough to take his income and push it up on one of those tests so that it actually changed how they taxed his Social Security, which means he went from having 15%, 40% of his Social Security being tax-free to a lower number that was now tax-free. So that's not good, right? That's not good at all. Well, okay, so what about Medicare? Well, Medicare, like you saw last week, that has its own issues as well. So here's another example. We got George and Martha. They have 306,000 of modified adjusted gross income. Now, there's a reason we chose that number specifically, and you'll see in a slide or two here. But they sell some stock. They're thinking, okay, we're going to be smart. We're not going to take money out of an IRA. We're going to sell some stock. We're going to get capital gains tax treatment versus income tax treatment. So they should only owe $188 in taxes on that stock sale, right? Wrong. What happens is that changes their modified adjusted gross income. Now it pushes them over that 306,000 number they had, which means they land squarely into the next bracket for IRMA, which is the means testing for your Medicare Part B and your Part D. And now their Medicare went up by about $100 per month per person for their Part B. It went up by about $50 per person per month for their Part D, prescription drugs. And so when you look at how much that's costing them in additional Medicare surcharges, that is almost $2,800. And guys, the real just kick in the shorts here on this, and I hate to be crude, but it is really, it's a 2-year look back. You sold some stock for $1,000. You thought you were going to have an 18% tax rate on it. You're thinking no big deal. 2 years goes by. You open up your Social Security statement and you look and you're like, wait a second, why'd my Social Security go down? Then you start looking. Then you get mad, right? I mean, it's what happens. So you got to watch out for this stuff. You got to watch out. Don't forget, you still got to pay the $188 in taxes you thought you were going to pay. So now you're talking $3,000 in taxes on a $1,000 stock sale. That's just no good, right? Another thing to think about with Medicare, sign up on time. I know last time we talked about the general, the initial, and the special enrollment periods, but just know this, if you miss your enrollment period, you get fined. It is a fine. They call it a fee, but it's a fine in my opinion. You get fined 10% on top of whatever premiums you're paying for life. So you could have been George and Martha, be like, oh, we blew it. We're paying the extra 10%, but oh, no big deal. Well, now it's an extra 10% on top of that additional IRMA bracket, right? So these things can spiral really quickly. Sign up for Medicare on time when you're doing tax planning, and that's why you want to work with us. I mean, this is one of the big reasons you want to work with us. We're not just going to review last year's 1040. We're also going to start looking at, okay, hold on, the stuff that's not on the 1040. What if income does this and now your Social Security taxation changes? What if income does this and now you're in a different bracket for IRMA? And the reminder that, hey, don't forget, in 2 years, your Medicare is going to go up because you did this, right? So those are things you got to think about. And that's why it's worth working with us. I've never met an accountant who's proactive on that kind of stuff. And accountants do a great job. They do, but they're always looking at last year's taxes, right? They're not looking forward. And it's just the nature of their business. Okay, Ken, what do we got for our next breakout session?
More taxes. So the first breakout, we're talking about asset location. How taxable are your accounts? Because one thing I really want you to take away, it's not what you can report. It's not the amount of growth you can see. It's not what you can show on a paper statement, of your investment accounts. The real question you have to be asking yourself, if I were you, is what do you actually get to keep? Now, what I mean by that, and Matt already mentioned it in one of the first slides, is you might have $1 million in an IRA. Congratulations. You might have $5 million in an IRA, even better. But the thing is if it's a traditional IRA, you don't have that $1 million. You don't have that $5 million. The IRS owns a portion of it. The question is how much? Now, the same thing is when it comes down to maybe your Morningstar reports or when you're tracking your investments, is I got 10% in my brokerage account. My follow-up question is did you? Because there's a phenomenon that happens known as tax drag. It's a drag on the performance of your investments, specifically in that taxable bucket. And so you might see a great year of returns. However, if you have those kinds of investment accounts, you're probably aware of the capital gains that you're needing to pay that year, the dividend taxes that you'll be paying that year. And so, again, we call that tax drag. It's a reduction on what you get to keep of your performance. So we're going to primarily be focusing on the far left column, U.S. large equity cap. Think about the S&P 500 companies. The dark blue is an actively traded fund, actively traded ETF or a mutual fund. And what we typically see is that there's a tax drag of about -2%. Now, that's just the tax drag. That's not including the management fees or maybe the advisory fees that you may be paying on that account. Now, the light blue is for a passively managed large cap fund. This could be the S&P 500, a passively managed index. Why is there still tax drag if there aren't many transactions? Well, because when a company does come in and a company does exit, they've probably been held there for quite some time. And so the capital gains are a lot larger when a move does happen. So it might not be as frequent, but when the moves do happen, it's larger. Now, by having a tax managed strategy, what we can see is that can have a major reduction on that tax drag. So it's the same investment philosophy, but completely different returns. And that's the same thing we like to bring to our financial planning processes. Same philosophies, but with a little bit more knowledge and a little bit more, elbow grease. What can we do? And that can have a profound impact over the long term. So what we're looking at here is if we started with $500,000 over the course of 20 years, if we were exposed to a 2% drag in performance, and that drag in performance could be fees, it could be taxes, it could be a number of things. But that $500,000 would end up at about 1.459. Again, not bad. I don't think many people would be complaining about that. But if we're trying to be as informed as possible and we can find some of those inefficiencies and we can reduce it from 2% down to 1%, well, that's an extra $300,000 in your family's pocket of not what you can show on paper, but what you can actually use. And if we can take that efficiency further, reduce that drag down to 0, well, now that's an extra $600,000. And what might you do with that? Is it more vacations? Is it time with grandkids? Is it putting your name on the wall of one of your universities? Whatever it is, that's your choice. It's just, you could have given it to Uncle Sam, or you could do something with it. At the end of the day, it's ultimately your choice. Matt, anything you'd like to add?
No. It's exactly what you said, right? It's up to you. It's up to you in terms of what you want to do and what you want to see happen. It really is. Okay, what else do we got to think about in terms of tax traps in retirement? So there are a few other things, right? Ken talked about buckets earlier, right? When do you use the taxable, tax deferred, and tax-free assets? Some of you might not have even considered that as an option, right? Well, one thing to consider is Roth conversions. And, really a Roth conversion is just the idea of you're moving it from a taxable bucket or a, tax me when it comes out bucket into a tax-free bucket. And you pay the taxes when you make the move, right? But then you never pay taxes again. When your spouse inherits that IRA, when you pass away, they don't pay any taxes, right? When your kids inherit it or whoever inherits it from, your generation, guess what? They don't pay any taxes on it either, right? So is it a good idea, thinking about what Ken said earlier about historical tax brackets and where we are, is it a good idea to take advantage of today's tax bracket system to do some of these conversions, pay today's tax rates versus whatever the $33 trillion of federal debt is going to dictate our tax rates are going to be at some point in the future? So that can sound like a good idea, but you got to be wise about how you do it. You got to have a strategy, right? You're not going to do it all at once. You're going to do it over a 3, 4, 5, even a 10-year period of time. And what you want to do, for most people, they're comfortable with the idea of, let's just stay in the same bracket. Let's not push us up into the 24% bracket if we're in the 22. Let's not go to 35 if we're in 32. Let's not go to 37 if we're not already there. But take advantage of whatever bracket you're in today and stay in that bracket. If you got $100,000 at the end of the year in terms of wiggle room, in terms of what you could convert, go ahead and convert it at that point, right? Convert the 100,000, but you're staying in the same tax bracket every year. A couple other things you can do to manage tax brackets. Life insurance policies. We have a lot of people who don't fully appreciate the tax advantages that life insurance has. If you have a life insurance policy that's built up an account value over time or a cash value over time, you can pull that money out of the policy completely income tax free. And there is no Social Security tax trap. There is no Medicare tax trap with it. And people just don't know that, right? And I think if more people knew that, more people would buy those types of insurance policies earlier in life. Could you sell highly appreciated stock for no or low capital gains? Absolutely, folks. If you are at least 1 year into holding a position and you sell it, you're going to get long-term capital gains tax treatment. And unless your household income's over $400,000, you're going to be at a 15% tax rate on that. So that's a terrific idea for people to use. And then you might have what's called the blackout period. So the blackout period is, say, let's say I retire at 60 and I'm going to go till, I'm waiting for Social Security to turn on at 67. Well, we already know Social Security has some tax advantages. So that's fundamentally, from a tax planning standpoint, that's a great idea. It's also a great idea from a tax planning standpoint to pull money out of your IRAs in your 60s while you're waiting for Social Security to turn on. And that's the blackout period. But what you essentially are doing is you're pulling money out of those taxable accounts when you have relatively low taxable income. A couple other things you want to consider: the health savings account and the qualified business income deduction. So health savings accounts are great. They are essentially Roth IRAs for healthcare expenses. But once you hit age 65 and beyond, they're like Roth IRAs. So if you're working still and your employer offers an HSA, guys, tomorrow morning, call them and find out how much can I put in my HSA between now and the end of the year, and what can I do next year to make sure I fully fund that, in addition to any kind of Roth 401k, 403b, or 457 option you might have at work, because it's going to function like a Roth as soon as you hit 65 and older. Qualified business income deduction. A lot of you have hobbies that you can monetize and turn into a small business. Do it, because if you do that, you get a below the line deduction for qualified business income. And for those of you who pay attention to that sort of thing, below the line deductions are always way more impactful, because they're like a dollar for dollar deduction, right? So the QBI, if you can qualify for it, if you have that small business, can be a great resource for you. A couple other things you can do. So this is a great thing that a lot of people just don't know about from a tax standpoint, excuse me, and gifting, especially to charities. So a lot of people don't want to get, just aren't really in a position to give away $100,000, $200,000 a year to a charity, right? They're able to give 5 or 6 or 7. Well, as you can see here, the standard deduction for a married couple, especially when you're looking at, things like the like the old age, and if you've got some health issues and stuff like that, the standard deduction is going to be at least $30,000. Okay, so if I give $5,000 to charity, you're probably not itemizing over $30,000, so you're not going to see any additional tax benefits for giving that $5,000 to a charity, right? However, if you do it through a qualified charitable distribution, and say the money's coming out of your IRA, if you send the money directly to the charity, they're going to consider that part of your required minimum distribution, but they are not going to tax you on it. Now, you don't get the deduction for taxes, but it does count as an RMD. You don't get the deduction. So why would I do this? Well, let's say I just give $5,000 to the charity, and let's say the money's coming out of an IRA. Well, if I want to give $5,000 to the charity, I actually got to pull $6,200 out, because if I'm in a 24% tax bracket, 24% of my distribution is going to end up, going to taxes. So I pull $6,200 to give $5,000. Did that blow up my Social Security? We saw what $1,000 withdrawal can do, right? Did it maybe put me over the top into the next IRMA bracket? Maybe. So there could be hidden costs in here too, right? But at a minimum, we know I got to pull $6,200 if I'm going to give $5,000. If I do it under a qualified charitable distribution, the charity gets their $5,000. This counts towards my RMD for the year. It is excluded from your income. The tax bill is zero. The Social Security impact is zero. The Medicare impact is zero. Your $5,000 that you pulled is $5,000 going to the charity. So it didn't cost you an extra $1,200, at least $1,200, to get that set up. All right, we're moving right along here. It is time for breakout session number 3.
Perfect. And this is really a good summary of really the last 3 workshops that you've now attended. It's Social Security, maximizing income, understanding some of the risks and costs around Medicare that we can just plan for. And by planning, might reduce some of the cost, but more importantly, provide that peace of mind that each of you deserve during retirement. And now we're talking about taxes, and this is where just a little bit more depth, some thoughtfulness brought into the conversation can have a profound impact. And so we've seen similar charts before in previous workshops where a household came in, they were looking pretty well. The baseline was projected to have a net after-tax inheritance to the family of about $7 million, and that's in future dollars, dealing with inflation. Now, what we were able to do was take their total tax bill from $1.5 million by layering in some of the strategies that Matt has been discussing so far, reduced it down to $600,000, a savings of just under $900,000. Now, that's also assuming the tax brackets stay the same. That's not assuming the tax savings that would be there if and when taxes increase in 5, 10, 20 years. By layering in some of those tax strategies, we saved an additional $40,000 of Medicare premiums in that surcharge. And that efficiency, saving just under about $1 million, added an extra $7 million to that net worth, effectively doubling their assets. And this isn't getting better market returns. This isn't having a great stock pick. It's literally just finding inefficiencies within a plan, getting them more in line with your values, your expectations. And with that, by going through the planning process together, we're able to have a bigger impact for you and your family.
All right. Well, how does retirement planning help me do that? Right? Especially retirement tax planning. So perfect segue. First step is, if you really want to do that, is get organized. There's nothing worse, and we've all seen and heard horror stories of people trying to figure out what mom and dad did, and nobody has a clue, right? And maybe mom and dad really weren't sure what they were doing either. So a couple things to think about, right? End of life is always tricky because you've got the emotional side of it first and foremost, right? And it's always hard. But then it's also the second part then becomes, how did someone pass away? What's the manner of their passing? Was it a quick and sudden incident or illness and they're gone? Or was it a long protracted affair and it got expensive and we weren't sure how we were going to pay bills and stuff like that? We don't know, right? We don't know. So we want to do planning, but we also got to think about, tax planning for today and income planning for today, but we also got to think about what happens at the end, right? What happens at the end. So a couple things to think about as you're considering what your options are. If you're going to do any kind of long-term care planning, if you buy a traditional long-term care policy, in most cases, those premiums are going to be deductible at the federal level, okay? Payments from long-term care policies, as long as they're under the IRS per diem, and as long as you have actual receipts to back up, even if you're over the per diem, guess what? Those payments are not going to be taxable to you as well. But choosing how you're going to pay for those long-term care expenses, that's going to have a big impact. Okay. So here's an example. We've got someone who is getting $5,000 a month in in-home benefits. She also gets $20,000 from Social Security, and she's got about $500,000 in an IRA. Now, in her 40s or 50s, and folks, by the way, that's when you should be buying your long-term care policies if you're going to buy one, is in your 40s and 50s. Can you do it in your 60s? Yes. Underwriting will be more difficult. You can still get it, but now you're 10 to 20 years older. Maybe you're dealing with a health issue. It's going to be a lot more expensive. Every single person I've ever met in 20 plus years who bought their long-term care insurance policy in their 40s is delighted that they did that when they're in their 60s, if that makes sense. They are really glad they bought it 20 years ago. Okay, so for people who say, "Oh, I've heard or whatever," I'm sorry, but you're hearing the wrong thing. You're absolutely hearing the wrong thing. But here we go. Okay, so Florence, she bought this policy years ago. What she did was she chose a life insurance policy that has a long-term care rider. Now, the way those work is if I just suddenly pass away, the 500,000 policy goes to the children. It goes to them income tax-free, and it bypasses probate. Okay, so it can't be contested in probate, goes right to the kids. They'll get it income tax-free in a lump sum if they choose to. The insurance company may have some other options for them, but most people take the lump sum. Now, that policy, though, because it has a long-term care rider, can provide up to $10,000 a month for long-term care costs. Okay, so what should Florence do? Well, here's a couple options that she now has. And folks, this is the key about financial planning, is it gives you options. The worst time to try to plan for the long-term care incident is when the long-term care incident occurs. We had someone years ago who tried to say, well, you know what, I get that my wife's concerned about this, but she can go down to the bank and she can mortgage something and all that. And I looked at him and I said, you mean to tell me she's going to be dealing with all the healthcare stuff and she now needs to go down to the bank and take out a mortgage and go through that process? Are you kidding? And needless to say, he and I didn't end up working together, but that's the question you need to ask. It's not as simple as you think it's going to be. And that's why you do the planning now, so you're making it simple later on because you have good options. Okay, so here's option one for Florence. Hey, she uses her policy. That's what she bought it for, right? So she has little to no income tax. Her long-term care insurance is going to pay, the $5,000 a month or whatever it is she needs. And hey, if she dies in 5 years and she used $300,000 of that policy, well, guess what? The kids will get whatever was left over in the policy, income tax-free, and they'll get the IRA in terms of whatever it's worth at the time of her passing. That will be taxable to them, though, when they pull the money out. So in this scenario, she gets what she needs. The kids will get a couple $100,000 tax-free. They'll get the IRA. That's going to be taxable to them when they pull the money out of the account. Not a bad option. Option two, well, we know she's going to pay little to no income tax in the last 5 years because her medical expenses are going to be greater than 7.5% of her adjusted gross income, which means they're going to be deductible to her. Maybe she uses the IRA money to pay for the long-term care. And the reason that might work is because the deductions may offset the income tax. So it's like she's pulling the money out tax-free. Now the kids are then going to inherit the $500,000 life insurance policy because she hasn't touched it yet, as well as whatever's left over in the IRA. So the question comes down to, Florence gets the care she deserves and that she planned for, but because she has two great options, The only question that she really needs to ask, it's not, how am I going to pay for this? The question is, okay, when I'm gone, how do I want it to go to the kids? Do I want as much tax-free money to the kids, or am I okay with them getting taxable money? And I'm not here to tell you which answer is the right answer. What I'm here to tell you is, because Florence did the planning, she has good options. And she's just asking what I would consider just a tactical question now. Do I want to leave money to the kids tax-free, or am I going to use the policy for what I purchased it for and leave some taxable money to the kids? I tell you what, the kids are just going to be delighted that mom had a plan. They are. Okay, so you might be wondering, how on earth are we going to manage all this? So we talked about, or I didn't really get into it, but the title of the presentation is 4 Stages of Retirement, right? So before you retire, after-tax savings picture, right? You've got to understand that. If you're going to fund Roth accounts, remember what I said about the life insurance policies that build up an account value? I would actually say fund Roth accounts and fund those life insurance policies. And also fund the HSAs at work. Get as much of that tax-free, get as much into that tax-free bucket that Ken talked about as possible before you retire. Early retirement, so your first few years, make sure you understand about the tax traps and Social Security. You don't have to know them in detail, right? You just need to know, hey, wait a second, if I'm going to do this, I'm going to give Matt or Ken a call, or someone on their team a call, to say, hey, I want to pull $5,000 or $50,000 out of my IRAs. What's that going to mean for me for my Social Security tax rate? What's it going to mean for me for Medicare, right? That blackout period I talked about, right? Maybe you're waiting for a pension to start. You're waiting for Social Security to start. Fill those tax brackets if you're going to do Roth conversions in those early years, or pull money out of the taxable accounts in those years when your overall income tax level is as low as possible. Get into your mid-70s, manage those RMDs, those required minimum distributions. There's a huge excise tax on those if you fail to take out your RMDs, so you got to remember to take out your RMDs. And then finally, as you're in that later stage of retirement, you're starting to think more and more about, okay, I'm not going to live forever. What do we got to do to make sure everything passes in the best way possible? Get organized and do the planning before significant events occur, so that when they do occur, you've got some good options. And so what I'm going to advocate for is that you work with us. And the reason why is because we're going to build a solution for you that anticipates when and how to access certain accounts. We understand from a tax planning standpoint the range of taxes you're going to face at different stages. We can work with your accountant to make sure the tax advice aligns with the financial planning advice you're getting. And then on top of that, one of the big things we do is we help you manage your actions a little bit. Hey, Matt, I want to spend $25,000 on this. I want to pull it out of the IRA because that's the biggest account. Hold on a second. Is $25,000 out of that account the best option right now? Let's take a look, right? We do those things every single day for our clients. And if you're looking for something like this, then guess what? We're the people you want to work with. Okay. So key takeaways from tonight. Spending phase, I wouldn't even say it's complicated. I would just say it's different than what you've worked under for the last 40 or 50 years. Managing taxes is something we can help you with all throughout retirement. It's not something you do once and you forget about it. Tax laws change, right? Your income changes, circumstances change. Do the planning to make sure that you've got good options so you don't get boxed into a corner and make a mistake because you were boxed into a corner. Because as you saw, some of those mistakes can really add up. And keep attending our workshops, keep being engaged with us, because as tax law changes, as our team continues to grow, right, and we bring more professionals onto our team, we may have a new service that we're offering at some point that could have a real good impact on you. Right. So just stay engaged with us as well. Even if you and I don't know why anyone would not want to be a client of ours, but just in case you didn't, stay engaged with us, because you're still going to learn more from us than you are from virtually anybody else in our peer group. So make sure you request that meeting if you haven't already done so. Thank you so much for attending. We're 3 out of the 4 done, right? Next week is estate planning. We're going to wrap that up before the holiday season really kicks off. But thank you so much for your time, everyone. I know we kept this one a little short, but remember, we just scratched the surfaces on taxes tonight. Okay, so from a tax planning standpoint, as we get deep with you in your situation. We fully appreciate everybody's situation is a little bit different. So thanks again, everyone. Ken, thank you for your insight in the breakout sessions, and we'll see you on next week's call, which is Monday at 6:30, and that's going to be estate planning. Thanks again, everyone. Bye-bye.